Okay, Chapter 4. Now, Chapter 4 is the hardest out of the four. We've done 3, so out of the 4 chapters. It deals with, now Chapter 4 deals with adjusting entries. You've done these again in applied accounting, but it just takes a little bit to kind of remember them. This chapter is a big chapter. The other 3 chapters, Chapter 1 we spent a day on, Chapter 2 we spent a day on, Chapter 3 we kind of spent a day and a half on. We spend all of today and all of Tuesday on it. I mean, it's a big chapter. We got adjusting entries, we got the financial statements, we got closing entries. And I mentioned to you the very first day of class, closing entries was a whole chapter in applied accounting, and it's a paragraph in this class. So we still spend time on it, but it just kind of shows you the amount of time compared to what you did in financial accounting. I mean, applied accounting, sorry. So we're going to go through and first talk about why do we need adjustments. Well, when we put all of insurance into prepaid insurance, why do we need an adjustment?
Because we're going to use the insurance monthly.
Because we're going to use up the insurance. When we put all the supplies we bought into supplies, what are we doing with the supplies? Using it. All right. And when we put all the revenue into unearned revenue, Ed Sheeran's coming tonight. Anybody going? I'm not going to do that. But 2 kids at the bus stop were, so I was laughing. And it is supposed to pour. Doesn't sound like it's going to be an ultimately fun night, but what does Ed Sheeran get to do with his concert money tonight or this month?
Recorded.
He gets to record it. So adjustments are needed because up until now, it is sitting in unearned revenue or it's sitting in an asset. And we need to take it and we need to put it on the income statement. We need to take that revenue that Ed Sheeran's been sitting in unearned revenue and we need to put it on the income statement. And we need to take all those expenses that's been sitting in the prepaid and show that they are recognized. So the cash has already taken place. The balance sheet's already shown all the cash come in. Or cash has gone out for our expenses. But now we have to show that we've earned it and we've used it up. So the solution is the end of period adjustments. Now notice I'm saying end of period adjustment because companies might not do these every month. All right? You might, and you're going to see this example when we go through. It might say we need to recognize 2 months of rent. They might do it at the end of December. They might not. It's not cost effective for someone to sit there and have their accountant go in every month and recognize 1 month of rent. 1 month of rent. Think about the Cardinals. Are they going to go in after every game and recognize the fact that they earned revenue after that game? No. They will probably go in monthly because of the number of games that they have. That would make sense. But it's not going to make sense for a smaller company to do something like that. So adjustments, how are they going to affect the balance sheet and the income statement? All right, so revenues we're going to record when they earn and expenses in the period in which they are going to match, which you guys talked about on the quiz we just had. So assets are reported as an economic benefit until the period in which they are used, and liabilities are reported at the end. So when we go through this, there's 2 different types of adjustments. You are not going to have to remember what adjustments go in what period. So like there's going to be what's called deferral adjustments and accrual adjustments. When I go through and I write them up on the board here, you are not going to have to remember that supplies is a deferral adjustment. But I want you to know what the word deferral means. And I want you to know what the word accrual means. All right, but you don't have to remember which ones go under what. All right, so a deferral adjustment is when revenue has been deferred until later, or an expense has been deferred to later, meaning we got the cash now, but we're going to recognize the cash later. So revenue, all right, revenue's been paid, but we did not earn it. So which journal entry says that we got revenue now, but we have not earned it yet? Cash and unearned revenue, right. So we're debit cash and credit unearned revenue. This is what happens at the beginning of a month. All right? We debit cash and we credit unearned revenue. So then when we need to do the adjustment, what would we need to do? We earned the revenue.
We decrease the unearned revenue?
Yep.
And
So the adjusting entry would be debit revenue, unearned revenue, credit revenue. We now recognize it. So these are deferrals. Again, you don't have to remember that this one's a deferral adjustment, It's just that's the purpose. You got the cash now, you're going to recognize the revenue later. So another one, the example that they're kind of showing up here on the board, is paying for something in advance like rent. We prepaid rent and we paid the cash. We're paying the cash now, we're going to use it up later, deferring the use of it to later. What do you think the adjusting entry is going to be? We paid for it now, we used it up during September, now we need to do an adjustment. Jessica, did you raise your hand or just happen to do this? Do you know what it is? What happens when we use up rent? I'll give you a hint. You're going to use the word rent in it. Rent expense, yes. So we're going to debit rent expense. And then what do you think we're going to credit? We're going to take it out of prepaid rent. Again, a deferral is saying we're going to pay for it now and we're going to use it up later. Can someone give me another example of something that is a deferral that we would, insurance expense, yes, prepaid insurance in cash. And then what would be the adjusting entry later? Insurance expense and PPI, prepaid insurance. All right? So we paid for it now, and we're going to use it up as we go along. Now another one that you see very often on your quizzes on homework, and an example in your homework, and maybe on a test, is one more that goes in here. Huh? That's revenue, so that's going to be like that one right there. It's still cash under the revenue. But I give it an example a lot. No. Now that's coming. That's going to be an accrual.
Income tax expense?
Nope, that's going to be an accrual. What's in my hand? Supplies. We buy supplies, and it's an asset. And I pay cash. So I'm paying for it now. Asset, asset, asset. Prepaid rent's an asset. Prepaid insurance an asset. Supplies are an asset. And as I use it, what's going to be my adjusting entry? Supplies expense and decreased supplies. Exactly. So we got 4 deferral adjustments. Again, you don't have to remember these 4 are deferral, but what's happening? We're paying for it up front, or we got paid up front, and we're deferring the recognition of them until later. Yeah.
So it means that we are decreasing the asset and revenue. Asset or expense or asset or revenue.
Right, and we're doing it at a later date, yes. Yep. And then here's the example of the revenue. The game for the download in advance, and just for an example, my son prepaid for NBA 2K, yes, NBA 2K19, okay, which comes out the 11th, but he gets it on the 7th, all right, because he prepaid. I don't know what it is. But anyways, I prepaid, I should say. He hasn't paid me back. So the game was received here, and then the prepay, and then they adjust it out when it is earned. And the money for, I can't remember who owns 2K, but when the game's released, then they earn it. Right now they haven't earned it. They haven't given anybody anything. Monday night at 9 o'clock is when I actually get the physical copy. All right, so with deferral adjustments, this is just something to keep in mind. Look at the adjustments on the board that I told you. Rent expense, insurance expense, supplies expense, unearned revenue. Deferral adjustments decrease one balance sheet account and increase a corresponding income statement. Increase income statement, decrease balance sheet. Increase, decrease, increase, decrease, increase, decrease. Or they involve one asset and one expense, one liability and one revenue. I was like, wait a minute. So notice. Now, you don't need to memorize that either, but it's just another thing you can look at to help you remember what accounts you're affecting. One income statement, one balance sheet. Same thing here. One income statement, one balance sheet. Your adjusting entries have one of each. You're affecting both financial statements. And then they give you there the examples that I just wrote on the board. All right, so accrual adjustments are the opposite. Accrual adjustments say that we are going to recognize the fact that we have an expense or revenue now, and we're not going to get the cash or pay the cash till later. So it's the opposite, accrual. We're going to recognize it now, but as earned or incurred, but we're not going to get the money until later. Right? So you guys have already named several when you were trying to come up with supplies. So which ones did you name? Give me a couple examples.
What is the question?
You guys named a couple of accrual adjusting entries when I was trying to get supplies. You shouted out a couple, and I said, not yet. Those are accrual. Do you remember what they were? Depreciation expense. All right, and we're going to do more on this one. You said depreciation expense. Do you remember what goes with depreciation expense? What's the credit? What was it? Not equipment. All right, but that is my most common answer, and someone is going to give that to me on the test if you guys choose to do problems. All right, it's not equipment. Equipment stays all by itself. It is a contra asset. Okay, so it carries a credit balance even though it's an asset. Remember I told you 95% of the time assets carry a debit balance? This one carries a credit. We have not talked about it yet. If I say it, you guys are going to nod. You're going to be like, ah, yeah, that's it. Accumulated depreciation. Remember that? I hope so. Okay. Accumulated depreciation. We're going to talk a lot more, and there's a whole chapter on depreciation. Accumulated depreciation. It is what helps reduce the value of a piece of equipment, like Alonda said. Did I say that right?
Yeah.
Okay. But it doesn't actually affect the piece of equipment, because do we actually know how much the piece of equipment depreciated? No, not until when?
It breaks.
No. What? An evaluation, or we sell it. Like I'm getting a new car, finally. Sometime this month, and when I get it, I'm going to be very excited, so I'm probably going to tell you about it. So I was driving a 2008 minivan for a very long time, and then I gave it to my son, which he wasn't happy about. And I understand, because I literally drove the parking lot, and it was the only minivan in the entire high school parking lot. But that's what he got, right? So then I was going to get a new car. So I drove my dad's minivan for 6 months, thinking then I got a new car. And then Jimmy didn't drive very well for the first 6 months and had a couple car accidents in the minivan. So then I didn't get a car. So I drove that minivan for a year and a half. And then right when I bought my dad's Jeep, thinking I'd drive that for a year and my middle son would get it, Jimmy totaled the minivan. Well, a deer totaled it in his defense. Totaled it. So he got my dad's van back again, the old van. Now that's a 2008, and I'm driving a Jeep longer. So now I'm selling the Jeep, and Joey gets the 2003 minivan, and I'm actually buying a new car, and I don't care what anybody else
What are you
gets.
gonna get?
I don't know. Down to 3.
Yeah? What are
Yeah. A Traverse,
they?
an Arcadia, or an Explorer.
Oh,
Yeah.
wow.
I don't know. I need a third seat still. I'm not a van. I'm not driving a van. I'm done with van.
Get Suburban.
I don't need a Suburban. How do I know, my point behind all that whole story, besides the fact that my kids don't know how to drive very well, is that how do I know the value of that Jeep?
No, until you sell it.
Till I sell it. I can go look at Kelley Blue Book, right? And they're going to tell me that it's approximately worth, I think they said $5,000 to the dealer, but it said up to $7,000 to $9,000 if I sell it by myself, which I'm like, right. So $5,000. But until I actually go to the dealer, how do I know what the dealer's going to give me? I don't, right? I also put the wrong year when I did it, so it's actually not probably worth $5,000. So you don't know. So this is just an idea of how much the equipment. So that's why we don't actually touch the value of the equipment. The equipment stays at the price, and we just put what we think it's going to go down by. All right, what's another one you guys gave me? How about that one? All right, income taxes. So we have income tax expense, and then we don't pay that now, so where does it go?
Accounts payable?
Kind of, but we're going to be very specific.
Interest payable?
Income tax payable, yep. And then later, income tax payable, I don't know if you can see that, and cash. That's what accrual says. Right now, we're going to recognize, because we have an expense in this month for income taxes, but we're not going to pay the income taxes until later.
What's the top one?
The top one, there isn't one. It's the only one that we never spend cash on depreciation, ever.
So why are we writing this in accrual, that depreciation expense?
Because we have to recognize it, because the value of the asset is going down, even though there's no cash being spent.
You don't want to have inflated assets.
Right. If we don't show that my car, okay, that 2012 or 13, whatever year my Jeep is it still worth the
Sticker price.
$30,000? I don't know how much the car was. It was my dad's. $30,000 that he spent on it? No. It's 6 years old. So if a company shows all their buildings and all their equipment at the cost that they bought them, for example, this building. Okay, this building is not worth anything. The land is. The land is what's value. Anybody that bought this campus, if this campus was gone and someone bought this, they would be buying it solely for the property. Then they would completely graze everything that's on it with all the asbestos and everything. They would completely get rid of everything. But they'd be buying it. Land does not depreciate, right? Buildings do. This building has long been depreciated.
Why does land not depreciate?
Because land itself does not devalue. The area around it could devalue, and that's why people like do what's called blighted land, and they try to tell you it's not worth anything.
You said blight?
I think that's the right word. Blighted. And basically, this area over in Kirkwood over here, right on the other side of 44, they tried to do that and tried to make it worthless, and tried to then give people some money, kick them out of their house, and they were going to build something, and it fell apart. People fought it. So they basically tried to tell you that your land is worthless. But it's not. It just depends. Now, some people take it, and then they have something called eminent domain where they can come in and just take your land.
So,
All right.
I have a question. So with the top one, the only time you would record it is you would record the value that you bought it at and then the value that you sell it at?
Right.
Okay.
Yep, equipment. You do the equipment and cash, and then when you sell it, cash, equipment.
Okay.
And then this goes out. I'm going to show you how this looks on the balance sheet eventually. All right, what's another expense? What's another expense that we would recognize right now and maybe pay later? Yep. Interest expense. Because we have that every month, interest payable. And then later we'll have interest payable and cash. What's the opposite of interest expense? Yeah. So interest receivable, interest revenue. That means someone owes us money, right? So then later, cash, interest receivable. I think that might, I'm trying to remember where I'm at. So there's our income taxes. There is one more. I don't like this one as an adjusting entry. I think companies do it as it occurs, in my opinion. But there's one more that they have, and it has to do with revenue. And I see why they put it on here. What's the other journal? There's 3 journal entries for revenue. Here, when we get it, and it's not earned. Cash, when we get it, and we earn it right away. And what's the third one? No? That's this one. Huh? Receivable. So accounts receivable, revenue, and then later, cash, accounts receivable. And that's this bottom one right there. And there's our interest. So they give you a couple, oh, we forgot, that's the one I forgot, wages. Wages, expense, wages payable. I don't know how I forgot that one. And then they pay the wages. Oops. All right, so again, one asset, one revenue, one liability, one expense. Now, with very few exceptions, if you were to look in this column right here, what do you notice about the majority of the debits?
Expenses.
Expenses, yeah. Expense, 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 expense. You have a receivable and an accounts receivable there. So if you have to guess on an adjusting entry, you have a good chance of guessing expense. The other thing, notice, is with each expense, the word before it
Usually
goes with what you're dealing with. And then the credit goes with what you're dealing with. So you don't have to make it up, all right? They kind of go together. You're adjusting what is in there. So if you can remember it needs to be probably an expense, then look at what you're doing and be like, okay, well, it's prepaid, it's rent expense, and I'm taking it out of rent. The only one that sometimes throws you guys is this one, but we'll get that ingrained in your head, the depreciation. All right, let's take a look at a problem. All right, so we're going to go a little farther, then we'll do it. All right, so adjustments aren't made on a daily basis. I already told you that. That would not be efficient. All right, we do them at the end of a period, not a month. So again, we have to analyze, does an adjustment need to be made? We don't always have adjustments that need to be made. And then where do we want to make them? So this is an unadjusted trial balance. And this over here is just kind of explanations of, do we need to do stuff? Well, here, decrease for gift cards obligations fulfilled in September. So they're kind of telling you what are they looking for to do adjustments. So those are all the different adjustments that could be made. Now, there's not that many because, for example, this revenue is for those gift cards. So some of these match up with some of those. So in reality, there's probably only 8 different adjustments going on. So let's look at this. Of the $600 in supplies previously received, $250 remain on hand at the end of September. So what do you think the adjusting entry is going to be?
350.
How much?
350.
350 to expense, and what's the credit? Supplies. And notice he said 350, and that's correct. This supplies can be tricky because they can be worded 2 different ways. All right? This one says 250 remain, but it could also say 350 or 250 was used. So you want to make sure, do you need to subtract, or did they just tell you what the answer was? So it can be worded either way. So just make sure you read the problem to see, did they tell me of the 600, 350 was used, or did they tell me of the 600, 250 was left? All right, so the general supplies, expense, and supplies. And then they just show you how it's moved from the statement. All right, 3 months of rent were paid in September of $7,200. 1 month has expired. Now here they give you a nice graphic. You're not going to get nice graphics when you're doing your homework or the problem. So $2,400 a month. So what are we going to have to recognize?
Rent expense
Rent expense for how much?
for 1 month.
For 1 month, so $2,400. So when we go through, it's rent expense, $2,400. Notice in the T accounts, you still then have $4,800 left in prepaid rent. And then each month, you'll take $2,400 out. Computer equipment, which was estimated to last 2 years, has now been used for 1 month, representing expense of $400. So here, this is your depreciation. They didn't tell you that, but that's what this is. You don't have to calculate it yet. We won't do that until we get to the depreciation chapter. So here, you just need to remember the journal entry. And then for right now, it's written up on the board. The journal entry for depreciation is depreciation expense and accumulated depreciation. So here we got a little bit more background. We kind of already talked about it. It's used for equipment, it's used for vehicles, it's used for buildings. Anything that's going to decrease in value. And when you have depreciation, I already told you it was a contra account. This is how it shows up on the balance sheet. So the original equipment's $9,600. It does not go away. Underneath it, $400. So then it gives you what's called net equipment or net value, and sometimes what we call that is carrying value or book value. Have you guys ever heard of Kelley Blue Book? Right. That's where you can go look up your car, and that's what I was talking about when I looked up my car. I looked up a 2013 Jeep, and then I got home and realized it was a 2012. So it's roughly the same, okay, but I imagine it's going to be a little less. But it helps with the fact that it will help because I have so low miles is what it's going to help with. But so carrying value is $9,200. That means I would expect if I sell that piece of equipment, I should get around $9,200. if I get more than that, I made money. If I get less than that, I lost money. Now, is it kind of funny money? Kind of. I mean, my Jeep, that Jeep that I bought from my dad is paid off. So if I get $5,000, great. If I get $4,000, I still kind of made money, right? So wherever it goes. I mean, the van that Jimmy totaled numerous times, okay, we got $500 for from somebody who could still drive it. So in my mind, I was like, that thing long exceeded. I have my dad's van that Joey's driving. It's a 2003 with 242,000 miles. That thing well exceeded its life. I swear there are more green town and country old vans on the road out there. I don't know what they did when they made those things, but it exceeded its life by like 8 years. So if I get anything from that outside of donating it to, you know, the South Tech for them to tear apart and try to figure out what's inside of it, that's a gain. So when you get above the value, and if the value is 0, it's a gain. So the journal entry again, and then you have this account, accumulated depreciation, over here, and then notice it says plus XA, that just means it's a contra asset. And then here they just kind of give you a little diagram showing you where accumulated depreciation goes on the balance sheet. Obviously depreciation expense goes on the income statement. We get down here to how do you figure out depreciation. You're going to learn 3 different methods of doing that in this class. All right, now they added one in here. We added this in the last book too, something called amortization. Now, we don't do a ton with this one, but amortization is only done using one method, and it's done on intangible assets. And we talked about intangible assets last chapter or chapter before. Intangible assets are something you can't touch. And this is a software development company, so an intangible asset is the software that they developed. So the software for Noodle Cake is estimated to have 3 years of useful life, and it's been used for 1 month. So it is exactly the same thing as depreciation expense, except for it's going to be called amortization expense. Right. So you have amortization expense and accumulated amortization. And it's a contra asset, just like accumulated depreciation is. No different, you're just going to put the word amortization in place of accumulated depreciation. And we don't have a whole chapter on it. We don't spend a lot of time on intangibles, but there's only one way to do it, and that's straight line. So it's a pretty easy amortization method.
1 minute, please.
What was that?
I was writing that, sorry.
Okay. All right, so here's our gift cards. We had they accepted the gift cards of payment from customers, and $100 of gift cards was redeemed. So what's my journal entry to accept the redemption of gift cards? What's the adjusting entry?
I think cash goes up.
Well, they already bought the gift cards.
We will increase the unearned revenue
Yep,
and increase the revenue.
yep. So it's our last one on the left side. They already paid. Adjusting entries, I'm going to say it before you see the slide, never have cash in them. Because you either got cash before or you're going to get cash after. All right, now we have $32.50 of consulting services to other app developers that we did give them, but they're not going to pay us until the next month. So we did the service, but they're not going to pay us till next month. So what's that entry?
Accounts receivable.
Accounts receivable and revenue. That's the one I said, I don't feel like that's an adjusting entry. I feel like you record that as soon as it happens, but they have that as an adjusting entry. And wages. Noodle Cake owes $19.50 in wages for people who work the last 6 days of September. So basically what that means is September and October kind of rolled into the same pay period. So they owe them 6 days of September, but it hasn't been paid yet. So what's journal entry?
Wages expense and wages payable.
Wages expense and wages payable. And you'll see that worded different, salary and wages expense. You can just put salary expense, wages expense. They mean the same thing to me. You don't have to write it all up. We have not paid, remember I told you this was going to be worded kind of like this. They have not paid or recorded. That means it hasn't been done. $100 of interest that they owe for this month. So you need to do it. What do we do?
Interest expense.
Interest expense and
Interest payable.
interest. All right.
So interest payable is not a contra asset at all?
No.
Because it's not.
It's a
asset.
liability, yep. Income taxes incurred but have not been recorded. Now, income taxes are a little different because the only way you can figure out income taxes is if you do all your adjustments, subtract them from your revenue, and come up with your income before taxes. Because you need your income before taxes to calculate your income tax. So this problem actually tells you, hey, it's 20%. Well, you have to go through, start with your unadjusted revenue and expenses, go through, subtract all what we just did, then come up with your new total. Well, I think our income is $1,000. Now your taxes are going to be 20% of that, so $200. Now you can do your last adjusting entry.
So in exam, will you give us this kind
In your
of-
exam, I'd probably just give you the total. I would not make you do that. But you probably will have to do that in your homework. Right? But you don't have time to do that on a test. And in the end, there's all your adjusting. That's why that trial balance looks so big with all those words, because you end up with all these wonderful T accounts that you can't read. Right? But once you're done with these T accounts, and this goes into an adjusted trial balance, you can do your financial statements. All right, so just a couple comments. One I already made. Adjusting entries never have cash in them. You either pay cash before or you pay cash after. Adjusting entries always have one balance sheet and one income statement. So if you get stuck that way, hopefully that helps. I can't talk. So that means they either have an expense or a revenue. And as you can see from up there, the majority of them have an expense. All right, so now